Larry, last we left, you were giving up on the bond long case and saying, look, I'm going to wait until there's a better spot to get in, is what I remember. And yields have continued to climb higher this week. So how do you view this now? Is the momentum still going towards higher yields? Or are there opportunities to try and go long?
Yeah, you're right. Last week I said I'm a bystander, I'm watching, and now things are different. We're near 175. I want to get long here. I think the odds of yields going to 160 are greater than going to 190. Right now, it seems like the market is priced to perfection. It's a dynamic that really leaves me skeptical. And I think investors at some point, and maybe that's Monday, I don't know, but investors will shift from seeking after bearish narratives for bond yields to go higher to more of a balanced approach. And I think the whole thing, like with SLR, the expiration of that Powell talked about, the perfect example. I mean, I think the big players knew that this would expire, and I think the market was just grasping for anything with green shoots and reopening optimism to get yields higher. So I think the pathway for me would be to see yields down at 160 before we see 190.
Larry, what are the causes for someone to buy a bond if we've got this trajectory for the economy? Is it, or do you have a view that we're going to run into some roadblocks here? Is it just a technical thing, saying 1.7% is a point of resistance, yield or support for price?
Yeah, I mean, the goalposts could definitely be moved higher. They were before, and I was wrong before. But at this point, it's not because 175 is a magic number. I just think we're post-Fed, and we now have a better context of monetary policy, economic expectations. I mean, for the value of repetition, Powell repeated the same thing 3 times this past month with regards to the outlook is brightening, recovery is far from over, we're going to do whatever we can as long as it takes. But all that to say, we still have 8.5 million people less in the workforce now than we did a year ago. Core CPI is running at 0.7 year over year on a 3-month annualized basis. That's how the Fed looks at it. Where's the reflation? Where's the reflationary trade? How far can it go? So at some point, I think the path of least resistance would be lower yields, and I think we'll see that between now and early summer.
Larry, the idea that we could have some slowness or surprising slowness in our bounce back for the economy is certainly, I think, a fair case to make. We have no idea how people are going to act, right? Everybody, I think, is expecting this big kind of spending boom. Maybe they don't. We don't really know what people are going to do. However, the case that I still have trouble getting through related to the Fed is that since August, AIT kicked off in August 10th. Federal Reserve Bank of San Francisco put out the note that they were going to do it. We gapped up in yield, and Powell has doubled, tripled, quadrupled down, to your point, promised more and more, and yet yield just keeps going higher. So it seems like the trend is telling us that in this regime, the only way you get yields to turn around is if there's a strong economic event. So it seems like this is betting on some kind of strong economic headwind.
Yeah, last week I would have totally agreed with that line of thinking, and it makes a lot of sense. Like, the foundation of your argument makes sense. But what I'm looking at is something that maybe most people aren't looking at, and I think it's more of a mind shift on investors. Instead of, investors have spent a lot of time with the bearish narrative, with the rah-rah, with like the now tracker from the Atlanta Fed's projection, and also with nowcast in New York, and all these kinds of things, and also with regards to the Fed meeting and the summary of economic projections, and SLR was such a big deal. So now that's over, it's passed, he's repeated himself, and we have to become more grounded at some point, and risks have to become more balanced, as it were. And I think one thing that's not helping is that the rotation that we've seen in the stock market has not really upset the overall value of the stock market. So that would be a case against me. But that said, I think the risks will have to, at some point, become more balanced, and people rethinking that, wow, should yields really be going higher when core CPI is still in the mud?
Fed told us, though, their core PCE expectation is 2.4%. I mean, the Fed is telling us, you think if there were anybody that might give us a little bit of a skew towards lower inflation, it might be them. But they looked and they said 2.4 is coming. GDP 6, that's now our baseline Fed estimate for this year. Why do I buy a bond at 1.7 if inflation's going to be at 2.4%?
Yeah, you shouldn't. But I think that the odds of that are slim, and I think the changes in our society are so huge, and not just because of the pandemic, although the pandemic's an enormous part of it. I mean, it's just structural changes with an older workforce, less people in the workforce, jobs becoming replaced as we speak, a lot more savings on the sidelines. And the bottom line, something I always say, is that the private sector just cannot multiply capital. If you look at the money supply, it kind of justifies that. And so it requires the public sector to do that going forward. So the changes in the society are so enormous that I just cannot see the correct kind of inflation that they're looking for come to us in a even fashion, in a fashion that's consistent. Will we get an uptick in it? Oh, of course. I mean, everybody got these stimulus checks. There's a lot of people are going to Walmart and buying TVs and stuff like that. But that will peter out quickly. And as Jerome Powell said, we all can go out to dinner, but we can only go out once a night. And so I just don't think the long-term inflation story is correct.